Most people believe that banks are simply middlemen taking deposits from savers and lending that money out to borrowers. But the reality is far stranger and far more consequential than that comfortable myth suggests. Banks don't actually lend out the money sitting in your savings account. And when you take out a mortgage or a business loan, the bank isn't handing you cash that someone else deposited yesterday. Instead, banks create brand new money, almost literally out of thin air, every single time they approve a loan. And this process, which economists call credit creation or fractional reserve banking, is responsible for creating the vast majority of money circulating in modern economies. Here's how it works, and why it matters more than you think. To understand how this works, imagine you walk into a bank and apply for a $50,000 car loan. If your credit checks out, the bank doesn't go into a vault, pull out $50,000 in cash, and hand it to you. What the bank does is simply type $50,000 into your account as a new deposit, and at the exact same moment, it records that you owe the bank $50,000 plus interest. In that instant, $50,000 that didn't exist a moment before suddenly enters the economy created by nothing more than a few keystrokes and an accounting entry. This is not a trick or a scam. It's the actual legal and operational foundation of modern banking, and it's been working this way for decades. The money you just borrowed didn't come from anyone's savings. It wasn't printed by the government, and it wasn't taken from the bank's reserves. It was conjured into existence by the act of lending itself. And that newly created money is now yours to spend on a car, a house, or a business expansion. When you spend that money, it flows into the real economy. The car dealer deposits it in their bank, and the cycle continues. Now here's where it gets even more interesting, and where most people's understanding breaks down completely. In the United States, roughly 97% of all money in circulation was created not by the Federal Reserve or the Treasury Department printing bills, but by commercial banks making loans. The government does create a small portion of the money supply, the physical cash in your wallet, and the reserves that banks hold at the central bank. But that base money is just a tiny fraction of the total. The rest, the digital dollars in checking accounts, savings accounts, and business accounts, all of it was created by banks through the lending process. So when politicians or pundits talk about the government printing money, they're usually missing the bigger picture. Because the real money creation happens quietly, invisibly, in the loan departments of thousands of banks across the country every single day. This system works because of something called fractional reserve banking, a framework where banks are only required to hold a small fraction of their deposits as reserves, and the rest can be lent out. Or, more accurately, used as the basis for creating new loans. In recent years, reserve requirements in the U.S. have actually been reduced to zero for many institutions, meaning banks can theoretically create as much money as they want, limited only by capital requirements, regulatory oversight, and their own risk assessments. The Federal Reserve sets the rules and monitors the system, but it doesn't directly control how much money banks create. That depends on how much people and businesses want to borrow and whether banks are willing to lend. During a booming economy, when confidence is high and borrowers are optimistic, banks create money, rapidly fueling expansion, investment, and consumption. During a recession or financial crisis, when banks get nervous and borrowers get cautious, money creation slows or even reverses as loans are paid off faster than new ones are issued. And that contraction in the money supply can deepen economic downturns. So where does all this newly created money actually go? And why does it matter to you? This is the part that almost nobody talks about, but it's absolutely critical to understanding why wealth inequality keeps growing, why housing costs have skyrocketed, and why your paycheck doesn't seem to go as far as it used to. When banks create new money through lending, that money doesn't flow evenly across the economy like rain falling on a field. It flows first to wherever banks are most willing to lend. And in practice, that means it flows disproportionately into asset markets like real estate, stocks, and financial investments rather than into wages, consumer goods, or productive business ventures. Let's break that down with a real-world example. Imagine a bank creates $10 million in new money by issuing a mortgage to a wealthy investor who's buying a second home or an investment property. That $10 million enters the economy, but it doesn't go toward building new factories, hiring workers, or increasing anyone's salary. Instead, it goes directly into the housing market. driving up the price of real estate. The seller of that property now has $10 million, which they might use to buy another property, invest in stocks, or deposit in a bank where it can back even more loans. Meanwhile, the average worker's wages haven't budged because the money creation process didn't touch the labor market at all. Over time, as banks continue creating money primarily for asset purchases, mortgages, and financial speculation, asset prices inflate rapidly while wages stagnate. This phenomenon, often called asset price inflation, explains why the stock market and home prices have soared over the past few decades, even as median incomes have barely kept pace with inflation. The money supply is expanding, but the new money is concentrating in the hands of asset owners, people who already have wealth, rather than flowing to workers or small businesses. If you own a home, stocks, or other investments, this system works in your favor. Your assets appreciate in value as newly created money chases a limited supply of houses and financial instruments. But if you're renting, working for a wage, and trying to save up for a down payment, you're effectively losing ground every year because asset prices are rising faster than your ability to save. This is one of the hidden drivers of wealth inequality, and it's baked into the structure of how money gets created and distributed. The economist Richard Werner, who has studied money creation extensively, points out that not all bank lending is created equal. When banks lend money for productive purposes, like funding a new business, expanding a factory, or investing in infrastructure, that newly created money tends to boost economic output, create jobs, and raise incomes. But when banks lend primarily for asset purchases, buying existing houses, stocks, or financial products, the new money just inflates asset prices without generating new productivity or wealth. Over the past several decades, according to research from the Bank of England and other institutions, the majority of bank lending in developed economies has gone toward real estate and financial markets, not toward productive investment. In the United States, mortgage lending alone accounts for a huge share of total bank credit, and much of that lending is for existing homes, not new construction. That means banks are creating billions of dollars in new money every year, and most of it is being used to bid up the price of assets that already exist, rather than to build new homes, fund startups, or expand businesses. This helps explain why housing has become so unaffordable in cities across America. It's not just a matter of supply and demand, it's also a matter of how much new money is being created and where it's flowing. Now you might be wondering, if banks can create money out of thin air, why do they ever go bankrupt? And why do we have financial crises? The answer is that banks don't create assets out of thin air, only liabilities. When a bank makes a loan, it creates a deposit, which is money, but it also creates a debt, which the borrower has to repay. If borrowers default, if they can't pay back their loans, the bank loses money. And if enough borrowers default at once, like during the 2008 financial crisis, banks can become insolvent. The money they created doesn't just disappear, it stays in circulation until the loan is repaid or written off, but the bank's balance sheet takes a hit. And if the losses are severe enough, the bank fails. That's why regulators impose capital requirements to ensure banks have enough of a cushion to absorb losses, and why central banks act as lenders of last resort, stepping in to provide liquidity when the system seizes up. The 2008 crisis was, in many ways, a crisis of money creation gone wrong. Banks had created trillions of dollars in new money by lending recklessly for subprime mortgages and exotic financial products. And when borrowers couldn't repay, the whole system nearly collapsed. So, what does all this mean for you, for your financial future, and for the economy as a whole? First, it means that understanding money creation is essential to understanding why certain assets keep getting more expensive while wages stay flat. If you want to build wealth in this system, you need to own assets, real estate, stocks, businesses, things that benefit from the continuous creation of new money. Saving cash alone won't cut it, because as banks create more money and that money flows into asset markets, the purchasing power of your savings erodes relative to the things you want to buy. Second, it means that the people who get access to newly created money first, typically those with good credit, collateral, and connections to the financial system, have a massive advantage over those who don't. This is sometimes called the Cantillon effect, named after the 18th century economist Richard Cantillon, who observed that the people closest to the source of new money benefit the most because they can spend it before prices rise. In modern terms, that means wealthy individuals and corporations who can borrow cheaply benefit more from money creation than workers who rely on wages. Third, it suggests that if we want to address wealth inequality and make the economy work for more people, we need to think carefully about how money is created and where it flows. Some economists and policymakers argue for redirecting bank lending toward productive investment, green energy, infrastructure, and small businesses, rather than letting it pile into real estate and financial speculation. Others propose alternative systems, like public banking or central bank digital currencies, that could give governments more control over money creation and distribution. The key takeaway is this: money is not a scarce, neutral resource that simply gets moved around the economy. It's actively created by banks every day through the lending process. And where that money goes shapes everything from home prices to wage growth to the concentration of wealth. Most of that money flows first to asset markets, enriching those who already own property and investments, while leaving wage earners and renters struggling to keep up. This isn't a conspiracy. It's just how the system is designed. And understanding it gives you a clearer picture of the financial forces shaping your life. This information is for educational purposes and does not constitute financial advice, so please consult with a qualified financial advisor before making any investment or borrowing decisions. And that's something worth remembering the next time you hear someone say banks are running out of money to lend. Did this change how you think about money? Let me know in the comments. And if you found this valuable, smash that like button, subscribe, and hit the notification bell. We're breaking down the hidden systems that run our economy.